Hi, everyone. Welcome to United Assets January investment webinar. Thanks for joining us. And as usual, I'm joined by Tom Healy and Jiorden Sanchez. We're going to take you through some key points from our quarterly letter in which we provide an update on some things moving markets last year and looking forward. And to start off, I'll turn it over to Jiorden for a market recap.
Thanks, Matt. So in reviewing the past quarter and year, as highlighted in Exhibit 1, the S&P 500 was up 2% in the fourth quarter, marking the fifth straight quarter of positive returns. It also closed out the year 25% higher, the second consecutive year over 20%. While strong, we would note performance remains concentrated in a few big tech stocks. For example, in the fourth quarter, the average stock, as seen in the S&P 500 equal weight, and the major bond indices, as seen in the Bloomberg US Ag and Muni, were down. Now, looking ahead, we are positive on the economy and corporate profits, given tailwinds from pro-business policies and artificial intelligence. That said, some of this enthusiasm may already be priced in. For example, as highlighted in Exhibit 2, outside of the formation of the dot-com bubble, market returns are usually more muted in the year following two consecutive years of over 20%. Further, there is potential for volatility given the market's sensitivity to a data-dependent Fed and policy negotiations in Washington. Later, we'll discuss opportunities to invest in this environment, but first, I'll turn it over to Tom to discuss the economy and Trump's proposed policies.
Thanks, Jiorden. As Jiorden mentioned, we had the tailwind of a strong economy in 2024, which helped markets, and that looks like it's continuing as we go here into 2025. And one of the things that's also going to likely add to that is optimism. And so when we look at Exhibit 3 from the quarterly letter, what we see here is both the U.S. Economic Optimism Index, which is consumers, and the U.S. NFIB Business Optimism Index, which is small business owners. Post-election, you can see a sharp uptick in both of those survey results. And that is really a new administration coming in with pro-growth policies. And so consumers are more optimistic, and therefore business owners are as well. Whether that translates into actual growth, time will tell. But clearly, there's a lot of optimism around a new administration. However, that's not really new. And so when you look at Exhibit 5 from the quarterly letter, you could see that in the first year of a presidential term. So this is year 1, 2, 3, and 4 that we're showing, and then the average. Absent a recession, which we're not calling for in 2025, market returns are very strong in the first year of a presidential term. And that, again, stands to reason, as we see with the optimism indices, is that consumers, business owners are more optimistic. That leads to more spending, which leads to more economic growth. But as Jiorden mentioned, there's opportunities and risks around President Trump's, key administration efforts. Things like immigration, tax policy, trade policy, and deregulation all serve to both create opportunities, but also add risks, uncertainty risks, implementation risks. And we're seeing that already in the market, which is likely to create a more volatile environment in 2025. And so we're already seeing that through December and January, that volatility start to increase. However, that's not the only thing that we're watching. Another key element that could add to volatility is monetary policy. So for that, I'm going to turn it over to Matt.
Thank you, Tom. So as usual, when looking at Fed policy, it's important to look at the bigger picture of where the Fed's going, where the Fed's thinking they're going, as opposed to the next upcoming interest rate change. And what we show you with the chart on the left side is that the Fed's own outlook has responded in different ways in the last couple of years to inflation surprises. So at the left side of that chart, you can see that the intermediate term outlook, where the Fed thought Fed funds rates may be by the end of 25, was moving persistently higher. And this was really in response to an inflation rate that was way above the Fed's mandate. And it was pretty clear that rates needed to be higher for longer. And that was a prescribed policy from the Fed. As we moved into the end of 2023 and into 2024, we were a little bit closer to the Fed's target. And what you see happening is when inflation surprised higher, the Fed's thought on what the necessary policy rate would be in the future, moved higher. And when it responded lower, same thing. So the Fed became a lot more data dependent as that last mile of inflation, which has been difficult to conquer, really presented itself. So switching over to the chart on the right, what we see here is in the yellow line, it's basically the yield on the 10-year Treasury and how that has responded leading up to and following the beginning of previous Fed interest rate cutting cycles. And generally what you see with the yellow line is that it tends to move lower. So as the Fed's lowering short-term rates, the 10-year Treasury yield too also moves lower, which results in higher bond prices for longer-term bonds. And what you see with the green line is that in this cycle so far, the yield has actually moved higher. So you see from the beginning of the cutting cycle, even though the Fed cut 4 times or 4 25 basis point increments, the yield on the 10-year Treasury moved 121 basis points higher. So, of course, a lot of the things we're talking about are feeding into that. Optimism over pro-growth policies, uncertainty over inflation, even the level of debt and how many new bonds will have to be issued. That's all factoring into the mix. But for us, we're seeing this as an opportunity to incrementally add duration to our bond portfolios and also doing so while increasing yield from cash instruments, which are actually yielding a little bit less now following the Fed's rate cuts. So our preferred method of doing this so far, given that credit spreads are very tight, we've done it by adding treasuries that are a little bit longer, TIPS that are a little bit longer as well, and longer term, very high quality municipal bonds. All right, so moving forward to the equity side, I'm going to turn it right back over to Jiorden.
Thanks, Matt. So we previously alluded to these solid fundamentals potentially being priced into the equity market. And while the market appears expensive overall, we'd also know that there are attractive opportunities under the surface. So for example, the S&P 500 trades at about 22 times earnings. This is above the historical 17 times. This is due to premium multiples assigned to a few big tech stocks that now account for probably about a third of the market, with the average stock at a much more reasonable 18 times multiple. One such attractive opportunity is in cyclical stocks. These are stocks that are sensitive to the economy. As Tom outlined, pro-business policies have boosted optimism and may boost economic activity, which would benefit cyclicals. So for example, in Exhibit 4, you see that earnings growth is expected to accelerate to about 15% in 2025 for the S&P 500. This is above the historical 8% rate. More importantly, this growth is expected to broaden beyond big tech stocks to also include other S&P 500 stocks, such as cyclicals. Moving to Exhibit 5 on the right, it shows the strong relationship between trends in the leading economic indicators and relative valuation for cyclical sectors. The trend line goes up and to the right, suggesting that as the economy improves, investors tend to assign higher multiples to cyclical stocks. So, given attractive valuation today and a potential catalyst from further improvement in the economy, during the quarter, we started to reduce our lean towards defensive sectors and started buying into cyclical sectors. This is just one example of the attractive opportunities we see, and we'll continue to look for such opportunities as we navigate through what might end up being a volatile year. With that, I'll turn it back over to Tom to discuss some planning-related items and close us out.
Thanks, Jiorden. Referring back to the letter, we closed the letter discussing some financial planning items, which we would point you to. One is it's 1099/tax season. Obviously, as Jiorden noted, after 2 strong years of equity markets, we're up about 60% from the October bottom in the stock market. But the team worked diligently both on the equity side and the fixed income side to harvest losses where we're able to try to offset the impact of gains. But for specifics, you can speak to your United relationship manager to go through the details on that. In addition to that, the letter outlines some planning items, new contribution limits for 401ks and 403bs, the changes to standard deductions, changes to the cost of living adjustments that the government uses for different items. So all the details of that is in the letter. And if you want to speak to anyone about that, obviously your relationship manager is available to do so. And with that, we look forward to a strong year this year, and we appreciate your time and efforts. Thank you.